Hello, all. Welcome to a brand new series of Those Damn Terms, in which we try to understand very important finance terms in the simplest possible manner, that too in less than 5 minutes. Today's term of discussion is EPS. EPS means earnings per share. That is, earnings of the company you invested in calculated for each share of the company. Suppose you invested in a company A. You hold one share. Just like you, nine other people also invested in the company. They also hold one share each. So, totally, there are 10 common or public shareholders holding 10 shares of the company. The company's revenue is 100 rupees, meaning the company A, from the sale of its goods or services, generated a total income of 100 rupees. But the company has some costs and expenses also, right? It has to pay 20 rupees for the cost of raw materials and labor, 10 rupees for advertisement costs and managing the office, 5 rupees towards debt payment, 15 rupees towards the wear and tear of the machinery, 10 rupees towards taxes. Now, what is a company left with? How much of its earnings are left? 40 rupees, right? Whatever earnings the company is left with after paying all the costs and taxes is nothing but net income. Out of this net income, the company has to pay some money to the important stockholders, also known as the preferred stockholders. You might be wondering who these important stockholders are. Preferred stockholders are the people who invested a lot of money in the company, more than we common people. Say, for example, there may be big institutions which invested in this company, or the company has issued some special stocks to its very important employees. They are all preferred shareholders, which means they are more important to the company than common retail investors like all of us. So, from the net income, the company has to pay out money to the preferred or more important shareholders first. This money is what we call the preferred dividends. If at all, the company has a policy of paying dividends, okay? So, in this case, let's say the company paid 10 rupees as dividends to the preferred shareholders. So, now what is a company left with? 30 rupees, right? This 30 rupees is what we as common investors totally have to look at. But remember, you are not the only common shareholder. There are a total of 10 shareholders as we discussed in the beginning. So this earnings of 30 rupees divided by 10 shares is the earning calculated for each share, that is the earnings per share. So to calculate EPS, you just have to divide the total earnings of the company by the total number of shares. More the earnings, more will be the EPS. Hence, EPS tells you how profitable the company is. Now, the question is, can we compare two companies by looking at the values of EPS and decide that the company with higher EPS is a better pick for us? No, not really. We have to look at other factors like ROE, return on equity, which is a topic of discussion for another day. But overall, we need to understand that EPS is a great indicator of the company's earnings and helps us decide on the company's performance in conjunction with other factors like ROE.